Now let's move on to bonds. Bonds are a fixed income security, and the interest rates and bond prices move in opposite directions, which is a key point when it comes to bonds. So that is, when interest rates go up, bond prices go down, and the opposite is true. And so these securities are ideal for someone who's looking for capital preservation and long-term accumulation of capital. So they're lower risk and a lower return than stock because of that risk and return trade-off. So here's what bonds have done relative to stocks. So the stocks are in blue, bonds are in green. So you can see that bonds are pretty steady, whereas stocks are a little bit more volatile. So this would be the return on a 10,000 portfolio if it were invested in stocks versus bonds. So let's talk about these key characteristics of bonds. They're kind of like a loan or an IOU because as a bond holder, you're lending money to that bond issuer. And then the issuer will typically pay interest to you every 6 months. Remember, on stock, dividends were paid quarterly, so these aren't as frequent payments. That payment is called a coupon. And so the coupon is the annual interest paid, and then they'll specify how frequently they'll break up the actual payments. The maturity date is when the loan ends and they give you back the principal. So a bond is typically has a $1,000 face value, so you would lend to the issuer in $1,000 increments. And then the maturity date is when you get your $1,000 back. So that $1,000 is what's considered the par value, or sometimes we call it the face value. And so if you sell the bond before it matures, it will not have realized that $1,000 value. So you may generate a capital loss or even a capital gain, because depending on what's happening with interest rates, that bond may be worth more than $1,000. But at maturity, just because of the way these instruments work, it's going to be worth $1,000, and that's what you will get back from the issuer. So we have some terms that explain all of this, and the first is a discount bond. So a discount bond is one that is selling below face value. So if it's selling below face value, that means that the price has dropped, so interest rates have increased. And then a premium bond is just the opposite. That means that that prices have gone up, and this is selling a greater than par because interest rates have gone down. So some other characteristics related to bonds, there may be some collateral related to a bond, meaning that it could be senior to other bonds, meaning that this bond has to be paid before more junior bonds could be paid, or that bond could be secured with specific property. Some other characteristics related to bonds, that bond could have a sinking fund provision, whereas it has an annual repayment schedule showing how the issuer has to pay off the bond. So that would give you a little bit more security in feeling comfortable that you were going to get that face value back. It could also have a call feature. That means that the issuer could just go ahead and repay you early. And so they would typically do that if they had the right, if this call feature was attached to the bond. And so they would engage that call feature if interest rates go down, so they could stop paying you that high interest rate, just pay you off, and then reissue the bonds and pay out a lower interest rate. So you'll see call features added to bonds typically when interest rates are high and they're anticipating them to drop. There are various bonds available in the bond market. Here are some examples. Treasury bonds issued by the U.S. government, agency and mortgage-backed bonds issued by various agencies of the government, municipal bonds that are issued by state, local governments, or even school districts, corporate bonds that are issued by corporations, and then convertible bonds, which are bonds that under certain conditions could be converted into stock. So going back through those, a few of those, Treasury bonds are going to be long-term securities issued by the government that mature in 20 to 30 years. Treasury notes are considered medium-term securities because they'll mature in 2 to 10 years. And then TIPS are Treasury securities that are adjusted for inflation. And the nice thing about bonds that you have to remember is that they are exempt from all state and local taxes. Not federal, but state and local. Now, an agency bond is issued by some subdivision or agency of the government. So that means it's not going to be an obligation of the Treasury, but it could be maybe issued by Fannie Mae or Freddie Mac, which are real estate related agencies. And their yields are going to be a little bit higher than Treasury yields because they're not risk-free like Treasury securities. So mortgage, actually, I spoke too soon about Fannie and Freddie. Specifically, Fannie and Freddie securities are going to be considered mortgage-backed securities. So an agency bond in a very general context is one that's issued by a subdivision of the government, but other than Fannie and Freddie. And actually, Fannie and Freddie are largely private now, so that's also makes them a little bit different. Now, municipal bonds are issued by state and local governments. There we go. And they're considered tax-free since the interest is actually the interest on these is free from federal income tax. And so on these, then we have to figure out, we kind of adjust the yield in order to compare it to bonds that do not have that tax-free feature. There are some other types of bonds, such as serial obligations that have different maturities and coupon rates related to those different maturities. Revenue bonds, where the income that they're going to pay out is generated by specific projects, which also means if that project doesn't generate the income that they planned, then they oftentimes don't have to make the coupon payments. General obligation bonds are kind of the plain vanilla variety, where they're just backed by the credit of the issuer. So we talked about corporate bonds. So now let's break down the corporate bond segments. There are industrials that they're largely represented by the Dow Jones companies that we talked about earlier. Public utilities, so those could be power companies, water companies, and so on. Rail and transportation, and then corporate bonds issued by financial firms. Now remember, we talked also about convertible bonds. These are bonds that could be converted into that company's stock under certain conditions. So you have to have that conversion privilege. There would be a ratio that would be specified about, that is the ratio of the number of shares of stock that each bond would convert into, and then there will be conversion values and premiums associated with that conversion process. Now, bond ratings are basically a measure of credit related to the issuer or to that particular issue. And so they're given letter grades. Unlike the credit scores that individuals get, bond ratings are letters ranging from A or AA, AAA, and so on, to B, C, D, and so on. So the lower the letter, the lower the rating. And so if you have a low letter and a low rating, that means the greater the chance of default. And the higher the coupon rate that company would have to offer, because again, there's a risk in return. So these are higher risk, so they have to offer you a higher return in the form of that coupon payment. So here's an example of two different rating agencies and their various ratings. So slightly different, but you can see AAA is going to be the best, whereas D is going to be pretty bad. And there will be certain investors maybe that are investing on behalf of others, like retirement plans and pension funds, that just can't invest below a single A quality bond because there's too much risk involved with the others. Remember, we said that bond price moves inversely with interest rates, and it's a function then of the coupon payment and, the length of time until maturity. And remember, again, we talked about the difference between a premium bond and a discount bond. A par bond, then, would be one that's selling at par or face value. So you can see here how the price of a bond moves with changes in interest rates and the difference graphically between a premium bond and a discount bond. So in this example, we're looking at a bond that has a 10% coupon rate. And if interest rates drop, that makes it a premium bond. And if interest rates rise in that bottom section, that makes it a discount bond. So you're seeing how the price of the bond is changing with interest rates. Some other measures that we should be aware of with respect to bonds are related to yield. Two different types of yield. So yield is a rate of return. One type of yield is a current yield, which is measuring the return that comes from the coupon payment. And the other is the yield to maturity, how much we would earn in total if we held that bond until maturity. So going back to the current yield, it's the annual interest income that we get on the bond divided by the market price. So this is similar to the dividend yield on a stock, because both of these, the current yield and the dividend yield, are a measure of your earnings from current income on the security. Again, yield to maturity tells us what our total return on that bond would be if we held it to maturity. So it measures our annual interest income and our recovery of principal at maturity. So if a bond is purchased at face value, then the yield to maturity is going to be equal to the coupon rate. If it's purchased at a discount, remember lower than face value, then the yield is going to be greater than the coupon rate, and then the reverse is going to be true. If it's purchased at a premium greater than face value, then the yield is going to be less than the coupon rate. And all of that is because of that inverse relation. Interest rates go up, bond prices go down, and I think the key is remembering that the yield is equal to the coupon rate when it's at face value.